Welcome to the Melbourne Property Podcast, hosted by Sky and Lindsay Hammer from Convergence Buyers Agents, your local property experts.
This podcast is your go-to source for insights, trends and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive insights that will shape your next property purchase. Let's dive in. Welcome to another week's episode of the Melbourne Property Podcast. For those that are watching this for the first time, welcome. Obviously, things are a little bit different this time around. We're in the studio, but we're also going to have some video content for YouTube and socials. So for those jumping on for the first time via visual means, welcome. It's nice to have you here. My name's Sky. I'm the co-host of the Melbourne Property Podcast, and with me here is Lindsay. Lindsay,
Hi,
welcome.
I'm Lindsay Hammer.
Today's episode, thanks to everyone that has submitted questions. So we had this one kind of lined up for a little while now. We've taken lots of questions, some through kind of social media, other through emails for those listening and submitting podcast questions that way. But today it's all about Q&A. So we'll be a little bit of data focused, but to be honest, it's going to be a bit more of the insight on what we're seeing on the ground. I guess maybe some do's and don'ts when it comes to property investing here in Melbourne, but lots of just kind of, I'd say slightly random questions as well that we received that we're going to work through together here today.
All right, and as most of our listeners know, let's start with what are you loving about Melbourne right now, Sky?
So for me, it's the continued growth. I think we're in now 4 months of continuous growth in the Melbourne property market. We're still off the highs. We're around about 4% kind of off those kind of March 2022 highs, but everything's still looking really good for a rebound in the Melbourne property market. What about yourself?
Well, as most of our listeners know, I've got 2 young kids, so I don't really get a lot of free time. Any of my free time when I'm not buying properties is really doing kid-related things. So I'm going to stick with that. I recently went to see the new Lilo and Stitch movie with my son, but what was really cool was the cinema. So it was in Southland, they've got like a V Junior cinema there. So it's a cinema exactly for kids. It's designed for kids. It's got a massive slide. It's pretty cool. So I just love that Melbourne has so many different things on offer. And as someone with young kids, I'm always looking for new things to get out and about and do.
Yeah, very good. So we'll jump straight into it today. So for us, as I said, it's a Q&A episode. We're going to work through a bunch of questions, but I think it's going to be, I guess, an interesting episode. As I said, it's going to not be so data focused, but as always, I guess let's kick things off with one of the better questions, I think, and probably one of the more asked questions that we received over the last couple of weeks. Yeah,
so question number 1, and we received this in a few different formats, but really, in a nutshell, is now a good time to buy in Melbourne, Sky?
And again, and I don't want to use this as an absolute cop-out, but it depends, right? So it's not just, it's a great time for everyone. So I'm going to break it down a little bit. So is it a great time to buy if you're looking sub $800,000? Absolutely. So for us right now, for most of our investor clients, where we're looking are in those markets under that $800,000 price point. So we're talking places like Frankston, Carrum Downs, those that we've talked about for quite some time now. So from an investment perspective, they're our preferred suburbs because you have both investors, but you have first homeowners, you've got downsizers, lots of people looking into these markets. So is it a great time to buy from a competition perspective? Not necessarily, but in terms of are you going to get capital growth? Are you going to get a really strong investment that's going to maybe set up the portfolio? Absolutely. So in that 800K range, that's kind of where we're looking right now, and I think it is a great time to buy. The kind of interesting market though at the moment is that 1 to 1.5 million. So again, you're obviously moving closer to the CBD in that price point, but there's really not a lot of action right now. There are some like, I guess, renovated properties and those types that have that owner-occupier appeal doing quite well, but we are seeing quite a lot of properties sit on the market in that price point. And so there is some opportunity there. If you're looking kind of a medium-term to long-term hold, there is some value there, but it's definitely not a market we're super active in right now for our investor clients.
And I guess it depends. Is this going to be your first investment property, your 10th investment property? Is it that capital growth that you need, or do you need cash flow? Because some of the rental yields on those higher price point properties are quite low, so definitely below 3% rental yield.
Exactly, yeah, and that's why we're in that sub 800K and below. We're seeing yields still around that 4%, which is almost unheard of for some of these pockets. So we really like that. And I guess the other market we haven't touched on too much though is that, let's call it 1.5 plus. And that's a really kind of flat market at the moment. Speaking to agents and also just seeing what we're seeing on the ground, there's still not a lot of movement in that market. So that would be another one from an investment perspective we're not active in, and I wouldn't be rushing in there. But again, as let's say maybe a first homeowner or someone looking to upsize, there's definitely some opportunities there. And whether that's kind of lowballing offers or just kind of finding the right offer for particular properties, I think there's lots of scope to get a really good deal at the moment, as long as you're not expecting like significant capital growth over the next 12 months.
So I guess what you're saying is there are markets within markets in Melbourne.
Yes, of course. And I'm sure there'll be a few other questions where the answer is going to be it depends on your personal circumstances. But this is definitely one of them where we're seeing the market not converging kind of, I guess, across the board, but in different price segments, it is quite different.
Very good. All right. Question number 2. Hi, Sky. Are there any Melbourne suburbs to avoid buying an investment property and why? I feel like this person has been following your socials closely.
Yeah, so this one, we get this question quite a lot, to be honest. For those that don't already follow me on TikTok, I've done some of these suburb reviews recently. Obviously, we share some insights into markets we are buying in, but I'm very big on education of markets not to buy in. There are a lot of markets in Melbourne that I would actually just run away from. There's just some that just you should not touch from an investment perspective. Sadly, though, they're actually some of the ones that most investors are buying into right now. So I'm going to cover off a few of these. If you don't already, try and find me on TikTok or even find Lindsay on TikTok and you'll see some of these suburb reviews we've done. Obviously, more visual kind of component to these as well. But I'm just going to name a few that I really don't like from an investment perspective. Tarneet, Clyde, Wollert and Truganina. These suburbs all have a few things in common, but the main one from a data perspective is that it's about the supply. And so all of these suburbs are synonymous with house and land packages, developers really trying to move stock. And so what we're seeing is like days on market, well over kind of 40, 50 days, supply side in double digits. So the markets we've been buying in are in kind of that sub 1, sub 2% of stock currently on market. These ones are 5, 10, 12% of stock on market. So if you think about it, like basically 1 in every 10 properties in that suburb is currently for sale, which is a huge number. Like imagine driving down a street and basically every 10th house is for sale. That's the kind of stuff that we're seeing in these suburbs, which again, supply is a killer to capital growth. So that's what we're seeing across the board there. The other part of why I'm really concerned about these suburbs is the vacancy rates. So again, investors are piling into these suburbs. They're on the fringes of Melbourne. And so there's not a huge rental demand for these properties. And so what particularly risk-averse investors are doing is that, let's say they're looking to invest in Melbourne, they start their research, they start Googling what's available. The people that are going to hit their top of their Google search results are developers and kind of front companies for developers as well, if you can put it that way. They've got the big marketing budgets. So they're plowing that money into SEO. They're plowing that into shiny brochures and glossy magazine pictures and that type of thing to sell these kind of up-and-coming suburbs. Up and coming, not in a capital growth sense, up and coming in they've been built in the last couple of years. And so we're seeing lots of supply in these markets and like incentives that trick, I guess, or convince those risk-averse investors like 12 or 24-month rent back. Any good investment that you're doing, doesn't matter where you're buying property, you should not have to rely on a guarantee that someone's going to rent out the property. So for me, that's a huge red flag. But to someone that maybe it's their first investment property, they're worried about like maybe not getting tenants when they purchase the property, they jump at that. So essentially what's happening is the developer will pay you, if you can't find a tenant, they'll pay you that rent over the first 12, 24 months, which again, I see as a red flag, but lots of investors like that security. What they're trading off though is basically any capital growth. These markets, we're not going to see capital growth in that kind of short, I'd even say medium term. So all those suburbs I mentioned are huge red flags and I'd do a lot more research if you're looking into buying in those suburbs and kind of think about why. Yes, you might get a shiny new house, but what's the infrastructure like? Is there a train line there? Do you see any capital growth potential? Would you live there yourself, which I don't usually recommend as a test case for investment, but it's something else I guess put to people to ask those questions before they buy.
Yeah, I guess, like you said, for those more risk-averse investors, buying something brand new where you're not going to have repairs straight up or have to do any renovations just to get tenants in can be really attractive.
Mm-hmm. Yeah, for us, we much prefer those ugly ducklings when we can find them. So it might need a bit of work and you're going to have that kind of cost maybe up front or delayed maybe 12 months. But the capital growth on something like that with much better land value and I guess land size, 600, 700, 800 square metres as opposed to 200, 300, which we're seeing in some of these suburbs that I mentioned, is going to put you in a much better position long term.
Very good. Okay, well, let's move on to question number 3. Should I buy in Melbourne or should I look interstate for better returns?
Again, it's another, it depends. So for us, obviously, we buy a lot of property in Melbourne. We're based here in Melbourne, but we are personally, we own property in multiple states. And I think it's definitely something you should do is diversify that portfolio. Right now, like I just see tremendous value in the Melbourne market. As I said, we haven't always been buying here, but right now, if you're in that $800,000 price point, there's just such great value and potential in the Melbourne market. I like it both for first-time investors. So let's say you're going out and buying an investment property for the first time, or you're just a first property and you're rent investing. Having a foundational asset in your portfolio, which is a $800,000 property, 3-bedroom, freestanding house in Melbourne, that's the type of property that can set you up the rest of the portfolio. So you sit on that one for a couple of years or even a year in some of these suburbs. You get really strong equity growth. You can then pull that equity out and then maybe buy into regional Victoria, regional New South Wales, Queensland, WA. My guess for the next market to move would actually be Tasmania. I've got a close watch on that one. Wouldn't be buying there right now, but I think there's a bit of potential there as well. Again, it's kind of like what Melbourne was 6 to 12 months ago, where people were kind of sleeping on it. And if you got in then, you could have had a lot of potential. So right now, I love Melbourne for that perspective. The feedback and the questions we got around here were places like Darwin and a few others. Should I be investing there again as well? For our repeat clients that we have coming back to us, we're buying in Melbourne right now. We're not buying in Darwin, and the main reason for that is because a lot of people are chasing yield right now. So in Melbourne, when we say 3.8 to 4% yield, that's kind of what we're buying our properties right now. It's really high for Melbourne, but it's actually really low for the investors, particularly that have been active since during and the start of COVID. So COVID was all about property booms where you're buying 5-6% rental yields in places like Perth, Bunbury, Townsville. So people are attracted to those yields, but for markets where you can get really strong capital growth, those yields don't really exist at the moment. So a lot of people are looking at Darwin and saying, it's the next Townsville. And I mean, there's some similarities in the two, both in terms of location, geographic location, humidity, but also crocodiles, but also obviously the rental yield offers a lot. It doesn't have the same fundamentals and the same kind of dynamic in terms of demand and supply. So for us, I can see why there's an appeal to somewhere like Darwin right now if you're chasing 5.5% rental yields. But I think longer term right now, particularly for a first property, I'll be looking somewhere like Melbourne to set up that portfolio.
I think we also get a lot of people come to us asking about, I've seen there's been a lot of growth in Perth and Townsville. Is that where I should be buying? But they've sort of answered their own question there. There's already been that growth.
Exactly, yeah. And we see that time and time again, not just now, but even a few years ago where people are buying into markets that might be a little bit too late. Again, they're probably people that are getting their stuff through mainstream media, to be honest. And what they're finding is that this market's headed up because it's grown 30% over the last 12 months. Is that the best time to get in? Probably not. There are some exceptions to that, like Perth and Townsville, for instance. You could definitely have bought 12 months into that cycle, even 2 years into that cycle, and you're going to make more money. But again, no one's really talking about the Melbourne market in a positive manner. So for us, what we want to do is maximise taking advantage of that in that kind of sleepy period. The smart investors and money are already obviously moving into that Melbourne market. But longer term, I think in, say, 12 months' time, when CoreLogic or Cotality, whatever they're called now, release their 12-month report, you'll see that Melbourne's going to be sliding up that list. And that's when people start to talk about it. And then 12 months later, people are saying, Melbourne grew 13% last year. And that's when people start to pivot, whereas the smarter money's had 1-2 years of capital growth already in that Melbourne market.
Very good. Okay. Question number 4. What is a buyer's agent or buyer's advocate, and what exactly do they do?
I think I might let you answer this one. I've done a lot of talking. I'll let you answer this one and then maybe circle back. We can come back to it.
Yeah, it's a good question, and obviously one that we get all the time because we're doing it all day, every day. So in a nutshell, a buyer's agent is exactly what it sounds like. A buyer's agent represents the buyer in a property transaction. So we don't sell property, we buy property. The selling agent, on the other hand, so the real estate agent that greets you, that you meet when you go to an open home, they have a legal and fiduciary duty to represent the seller, not you, the buyer. So their job is to get the best possible deal for their seller. And I think a lot of people don't understand that. They think, they're really friendly, they're really nice, they're trying to help me buy this house. No, they're trying to get the best deal for their client, the seller. So really, a buyer's agent is there to just level that playing field. So a real estate agent is an expert negotiator. You want someone like that on your side to level the playing field, and that's what buyer's agents do. And for those that don't know, in Victoria, a buyer's agent is called a buyer's advocate. So same role, same job, just a different terminology really.
Yeah, and you hear buyer's advocate a bit in New South Wales as well, but I think a lot of the rest of Australia do use the term buyer's agent. I just find myself saying BA a lot more, just because it's a bit more interchangeable and easier to describe. But I think what you've said there is a good overview. I guess the buyer's agent or the BA, buyer's advocate, represents the buyer, whereas a traditional real estate agent will represent the seller. So a few distinctions there. The really good selling agents make buyers think that they do work for them, and they're really good at capturing that, that buyer demand. So let's say they list a property, has 15 interested parties. Obviously, one buys the property at the end of the day. The really good selling agents can harness those buyers, and then they've got another 14 buyers ready to go on their next property. So they'll keep in contact with you. They'll talk you through the process of kind of what's coming up. So I think the really good sales agents do quite good at that. But at the end of the day, particularly for first homeowners or first time investors, you don't want to attach yourself to one real estate agent, which we do see.
You're really limiting yourself if you
exactly.
do that.
Yeah, you're only getting a subset of all the available properties. So just keep that in mind as well. But the really good real estate agents do make you feel like they work for you, I think, at the end of the day.
Yeah, and I mean, it's the biggest financial decision most people make in their lifetime. Buying a house, it's not like just going down to the shops and buying a new dress or a handbag or something. It's a huge financial commitment. So you really want someone on your side representing you, I think, when you're making that kind of commitment.
Yeah, yep. And in terms of the process as well, I'm happy to expand on that. So for us, like let's say we have plenty of people reach out through the podcast, reach out to us and they want to have an initial call to see, can we help, right? That's generally the question that they have. So for us, we do that introductory call, get a better sense, not like an in-depth call, but get an understanding of what they're looking to do. If we could think we can help them, then great. What we do is like a 1-hour strategy session. And in that, the first half of that is very much focused on their actual requirements. Like, what are you looking to do with this purchase? What are you looking to do in 5, 10, 20 years to make sure this purchase is actually going to kind of help them get to there? Because we don't want to go out and buy them this perfect property, but then they plan to move overseas or they plan to buy their dream home in 6 months' time. Like, we want to make sure that it's kind of set up for success from the start. Second half of that strategy session, though, that's when we actually really focus in on where we're buying and why. So how I usually do it is I actually run share my screen. I use our heat mapping tool to explain from a data perspective. These are the 3, 4, or 5 suburbs that we'd recommend. Here's the data. Here's our heat mapping to explain from a visual perspective why we're buying in these markets, because it's all about education, particularly for first-time investors. We don't want to then start setting properties and say, yep, you should buy this property in this particular suburb. We provide all that information up front. So it gives us, that ability to act very quickly in the market, because it's not like we're presenting a property to a client and they're saying, oh, what's this suburb like? It's like, okay, great. This property's in Frankston North, for example. Let's go and buy it. That's kind of because we need to have that speed in these hot markets, particularly when we're transacting a lot off market. So we'd like to do that education piece up front. So that's kind of the main big step up front. And then obviously it's then the identification, sourcing, negotiating of property, getting out there, finding these really good deals for our clients. We also then have a whole kind of suite of trades and expertise behind us. So property managers, conveyancers, building and pest inspectors. We have all those ready here in Victoria for our clients. Some obviously bring their own, particularly mortgage brokers. We have a lot that bring their own mortgage brokers. But again, we've got that team behind us to help when we kind of need to move quite quickly, or even just as part of our due diligence process.
And what sort of things do you look for during the due diligence process?
Yeah, so for us, we obviously do a lot of that behind the scenes, and so we're not worrying our clients with that. But for us, it's the usual checks like, is it a main road? Is it across from a school? Is it in a flood zone? If it's development potential, like are there any kind of overlays that we should be aware of? Particularly in some parts in Victoria, people don't think about flooding, but flooding actually can be quite an issue. But also like sewerage lines and others, we obviously do all those checks for our clients as well. So that'd be the key ones. There's obviously a lot to do other than that. A lot of that's done behind a desk, but then it's all on the ground. So for us, particularly in the markets we're buying in right now, if you have a look at Google Maps, it might look perfectly fine, but if you're not looking at a house, maybe either side, what's behind the back, there's definitely some ways you can get caught out in this market. We've seen a few or heard of a few examples recently of people buying from interstate, like houses that we know we'd never touch, and then obviously speak to the agent and it's like, oh, it's an interstate investor, bought sight unseen. They just went off the video walkthrough that was sent through them. So again, in that video walkthrough, you're not getting a look at what the neighbours' properties look like. Is there a housing commission next door or over the back of the property, which we saw a really bad example of recently as well. So lots of different, points to look at, but for us, it's very much hand-holding along the way with our clients.
So really, you're providing that full end-to-end service, making sure everything goes smoothly. It's a seamless and hopefully an enjoyable process.
Yeah, I mean, it is. It's enjoyable. Obviously, a part stressful, probably more so for us than the client sometimes. But for us, it's trying to minimise the stress, maximise like the fun of the process, because it should be a fun process, and then giving them the heads up in the morning when and where to expect, the scaries to pop up. So for us, a lot of it's talking around building and pest inspections. I've never seen a perfect building and pest report come back, so it's kind of educating the buyers and our clients to say, look, we're doing this to find any kind of potential issues with the properties. That is the job of the inspector. So when you get the report back saying here's 20 issues, a lot of them obviously minor ones, but just to have them ready. There was an example recently where there was some structural stuff found in a property. So our job isn't to say, okay, goodbye, let's end this property purchase. It's get structural engineers involved. It's get people, builders in second opinions, third opinions, and actually work out what the issues are and how much that's going to cost. Some cases, that means we seek a pretty significant price reduction on the purchase, or at the end of the day, we might walk away. But it's making sure we've done that kind of thorough due diligence on behalf of our clients.
Very good. A lot goes on behind the scenes then.
It does, yeah. Not all sunshine and rainbows, that's for sure.
Question number 5. What suburbs offer the best value for families right now? So this one's probably more up my alley. I work with a lot more owner occupiers and a lot of them are families. And again, it really just depends on your personal circumstances and what your requirements are. So what's your budget? Always a good place to start. But also, are you looking for a particular location? Do you need a specific school zone? Do you need to be close to family? Are you commuting into the city and need to be close to public transport? So all those things would really factor in where's the best place to buy. But I can talk through, I guess, some of the more popular suburbs and places that people are coming to us asking for help. And a lot of that's because they're sought after suburbs, but there's not a lot of supply. So if you've got a healthy budget of, say, 1.7 million, then suburbs like Bentley and McKinnon are obviously really popular with families. And a lot of that's to do with the school zone. So you've got McKinnon Secondary College there and Bentley West Primary School as well. And both of those are really tightly zoned. So you have to be within that school catchment zone to be able to get in. So obviously, if you're buying a property, you need to make sure that it's within that zone. If you've got around $1.3 million to spend, places like Vermont or Eltham, you might be able to pick something up in Glen Waverley as well. And then if your budget is less than $1 million, places like Frankston, where you can get into the Frankston High School zone, obviously very popular, and neighbouring Langwarrin as well. So whilst that won't be in the Frankston High School zone, still really popular with families. Other areas that sort of come to mind are like Chelsea Heights, Keysborough, Belgrave, really popular with families, and particularly for that affordability factor. So all of these suburbs that I've mentioned have a high owner-occupier percentage. So that means there are more people living in the area that own their home and live in the home that they own as opposed to renters. And that just brings more appeal for owner-occupiers and families to live in that suburb. They all have good school zones, so another thing families are often looking for. And those last few that I mentioned are affordable. And obviously we've got a cost of living crisis here in Australia at the moment, so affordability does really factor in.
Yeah, do you expect that to change much? Because I know we've seen it from the investment side. Like as soon as that first interest rate cut happened, our inquiry obviously went through the roof. Like there's a lot of people, we're even getting it now. Like I guess over the weekend we had some new inquiries and it's all about trying to get into the market before everyone else, the interest rate cuts. Like that's already happened. Like we've already seen that inquiry. We've already started buying properties for clients who did move quite early. I think there's already been some that have maybe reached back out again to us and are now ready to make that move. But I haven't really been tracking it from the owner-occupied side. Would you say that it's changed much, or do you expect, I guess, as interest rates continue to come down, you're going to see that inquiry kind of pick up? And is it enough to move people from, let's say, a $1.3 million suburb to the 1.5? Or do you think people have set budgets and they're kind of sticking and getting a better quality house in those same suburbs?
I think it's a little bit like the chicken and the egg, really. Like you said, there has been that more buyer confidence with the interest rate cuts. But then that's also meant there's more competition and more people looking. So that's then driving up those house prices. So we're seeing stuff flying off the market in places like Cheltenham. There's just not enough available. So that is driving up those prices. So people really aren't able to get more for their money despite having more confidence now because there's been the interest rate cuts. So it's a little bit the chicken and the egg.
Yeah, it makes sense. Yeah,
if you had the benefit of hindsight, buying back when interest rates were higher, but with the knowledge that they are going to come down, that would have been the sweet spot, I guess.
Yeah, yep. And I mean, there were people doing that, but yeah, probably, I guess, a few more that they were waiting for that to actually happen before they, I guess, took action. So, okay, yeah, good to know. Just, out of curiosity, was just trying to see what it was doing on the owner-occupier side.
I think one thing we are seeing, particularly on the owner-occupier front, is these next few months, so June, July, August, are really quiet. The winter months there's not a lot of new stock coming to market. Most people wait until the spring. There's obvious perceived benefits anyway of selling in the spring when the weather's warmer, there's more sunshine, the house has a nicer feel to it, flowers are in bloom. But I also think that also represents an opportunity because some people have to sell. whether it's a distress sale, people are going through a divorce or something, or they're just in a bit of a financial crunch and they need to sell. If you can get access to those properties off market or pre-market before they plan to launch in September, I think that's a real opportunity for some owner-occupiers to get in.
Yeah, and we've seen that, like some of the off-market properties we picked up in the last few weeks. Actually, it falls into two camps. There's people that have to sell before June 30 for tax reasons, for the contract to be signed in this financial year. So you can get a pretty good deal, and we're actually working on something similar at the moment. Or it's the opposite. It's people want to sell, but they can't until 1st of July ticks over because, again, for tax reasons, they need that contract to start in the next financial year as well. So there are some opportunities to present there as well.
All right. Moving through, question number 6. We are trying to buy our first home, but we keep getting outbid at auction. What are your top tips for bidding at auction? This one probably falls more to me because I tend to go to more auctions than you do. A lot of your investor clients, you're getting stuff off market or private sale. I guess my first tip is to know the market where you're buying in. So that's not looking at the price guide. So don't rely on a price guide. Look at the last 3 months, 6 months if you have to, of comparable sales in that area, and make sure you're actually looking at comparable sales. So apples to apples, not apples to oranges. So look for a similar composition. So same amount of bedrooms, same amount of bathrooms, similar land size and similar features. So if you have a modern renovated home, and you're comparing that to an unrenovated home, that needs to be factored in. So really understand the market that you're buying in so that you're not caught out and trying to bid when your budget's just never gonna get you there. Speaking of budget, that's my second tip, is stick to a firm budget. Know your limit, don't go above it. And that's actually something we do with our clients. We have a written document that says this is your upper budget and we don't go above that. We see at auctions, people get really emotional, they get invested, so they go above their budget and pay over. They're paying overs for a property, really. And I guess if that's your home to live in, then that is okay if you can live with that. But that's not our job. We want to get our clients the best possible deal.
Yeah, and they can actually afford to do so. That's the one where we get, I guess we see when people do that and they can't afford to, I guess, those additional holding costs, that's when it can get pretty dramatic.
Exactly. My third tip is sort of strategic bidding. So don't just go in being like, this is my upper limit and I'll just bid until I get to that. Have some kind of strategy, and there's a few different strategies. You can just Google them, and not one's always going to work, but at least come up with some form of strategy. So it may be that when you're nearing the upper part of your budget, you start to slow down the momentum. So instead of doing in $10,000 increments, try and throw something in there. It doesn't have to be $5,000, could be $6,000, could be $7,000, really just to slow that momentum down. And I also recommend sort of trying to present yourself like with confidence, because other bidders are going to be looking and knowing when you are sort of reaching the upper limit of your budget, and they're going to try and leverage that. So body language is really important. Be deliberate. Stand there with your arms folded. You mean business. And that way, when you are nearing the top of your budget, hopefully no one's going to know. That sort of is my fifth point as well around people watching. So look for cues amongst the other bidders to see if their bidding is slowing down, if they're potentially nearing the top of their budget. And also ask the real estate agent who the auctioneer is going to be, because the auctioneer also will have their own body language. And if you can actually get around to a few auctions that auctioneer is going to be at in the weeks leading up, you might be able to get a few pointers for, whether you're getting close to the reserve or how the auction's going really. Some of them work really fast. So, you've got your going once, going twice, going 3 times. Some of them actually work really fast. And if you're not in there, the property could be sold before you even get a chance to bid, because I know some strategies are wait until the last minute, but it depends on the auctioneer. They all have their different strategies.
Yeah, I haven't seen too many auctioneers get once, twice, 3 times sold without really kind of dragging every last set out of people. But yeah, completely understand. Every auctioneer is different, and there's some that is if there's 5 seconds without a bid, they'll start that call and they'll basically try and drum up kind of interest that way. But then others, as you said, if they know, particularly the auctioneers, they'll know exactly how many bidders, who the interested parties are. And if someone's out that they know was maybe just only this other second bidder, they're not going to waste anyone's time. But yeah, you're right. You need to have that strategy in place. I do like the slowing down tip as well, in terms of slowing down the pace of the auction. Obviously, one way to do that is changing the bid, making awkward numbers. The other is to just sit there. They're not going to, if you can ask for more time, you can slow the auction down, get on the phone. You don't even have to be on the phone to someone. You can pretend you're calling your mum and dad or your broker, whatever it needs to be. They're not going to end the auction on you. you're probably going to annoy some people and they're going to call it out eventually, but take that time, slow it down. The other one that we do see work well as well, like we've gone to auctions. Like personally, I hate auctions. I enjoy doing them. They are the most transparent way to buy property. A lot of people have issue with it about transparency, but I think it's actually the most transparent way.
You're literally seeing other people putting their bids in.
Exactly. Yeah. But for me, it's not the smartest way to buy property. So when we can, like we obviously try and buy off market, pre-market. The property can be listed online, but getting an offer done prior, because that way like for us in particular, we've done our comparable market analysis. We know how much the property's worth, so we would like to buy that property for that amount or below. Once you go to auction, I don't want to say this in a negative way, but you're going up against lots of people who don't know what the property's worth. They think the property's worth what the market pays, and then the market pays, you only need two people, one person that has essentially an unlimited budget to keep on bidding up. And if you want that property, you're going to outbid that person who may have not done a comparable market analysis at all. We've definitely seen that happen. So for us, we would much prefer to buy in that kind of window where it could be a private sale where it's listed, but again, off market if we know and are confident in that price point.
Okay, well, we're getting close to the end of this episode, so let's crack on. Question number 7, what data points do you look for in an investment property and how is it different for an owner-occupier? Do you want to start with from the investment perspective?
Yeah, so from the investment side, what we're always when we're looking at property and property data, all we're looking for is where you're going to get capital growth and whether that's short-term, medium-term, long-term, and it all comes down to demand and supply. So all the metrics we look at are basically some form of take of either demand side, supply side, or a combination of both. So the big ones, again, if anyone follows us on social media, I talk a lot about days on market as a number to consider. And when I say days on market, I mean if you list a property online today, how many days does it take to sell? Melbourne, very auction heavy market, but if you get out of that kind of CBD and inner ring location, that days on market number is a really good kind of figure to track in terms of how quickly property is selling.
So that's a demand metric?
It is. It's a demand metric. So basically it means like if you're seeing that number under 30, it's a pretty contested market. The markets we're buying in right now, that number's more like 14, 15, 16 days. So instead of taking 1 or 2 months to sell a property, it's taking 2 weeks. So again, doesn't take much more than common sense to realise that that's the kind of demand and pressure you need in a market to see that short-term capital growth. So days on market, one of the big ones we look at. Some other ones though, like stock on market, so the percentage of stock currently listed available for sale. There's another one we look at from the supply side. So we're saying, okay, if there's 2% of properties currently available for sale, it's probably a relatively balanced market. We're starting to approach more of a seller's market. Again, some of the markets we're buying in right now, that's 0.3, 0.2% stock on market. So basically there's no stock available. We're talking a couple of properties each week popping up. We're talking hundreds of buyers looking at these properties. Again, doesn't take much to realise that that's a market we can get really strong capital growth. So the two of the big ones. Other ones, obviously for investor clients, are vacancy rates. You want to see that vacancy rate kind of 2% and below. In some markets we're buying in, we're happy with that being a little bit higher. But others, that vacancy rate's 0.5%, 0.6%, that type of thing. So the tighter the vacancy rate, obviously means if you buy a property, you're going to get tenants in really quickly, but you're also going to get upwards pressure on rents. Again, we want to see that rental growth over time. So that's another market, another indicator that we track quite closely. They're all, I guess, suburb level ones. If you take a little step back, we're obviously looking at stuff like infrastructure spending, what's happening in the region, building approvals. Like, again, I've mentioned this earlier, but supply is a killer to capital growth. You don't want to be buying in a suburb that's got a lot of building approvals. So if there's another 400 or 500 properties about to pop up in this suburb, again, that's another 400 or 500 properties that are about to be sold or transact in that suburb, which is really going to slow down that capital growth in the short term. But I'd say the medium term as well.
Yeah, and I'd say from the owner-occupier perspective, we're still looking at the same data, but from different perspectives. So I'm looking at days on market and stock on market, and I'm thinking, is this a seller's market? Is it a buyer's market? But also how much supply is there? Is it going to be really difficult to find what my client's looking for in this market? So we're still considering it, but not from the same perspective. On the other hand, though, whilst people are buying a home to live in, and so, there's that emotional element attached to it, we still want them to buy a property that has capital growth over the long term, and they can leverage that down the track. So whether they're looking to upsize and buy a new home, or maybe they're looking to build out their property portfolio, they can still turn to their principal place of residence, and it's been a good investment asset for them.
Yeah. Yep. No, that makes complete sense. Same data, but maybe a slightly different take on it as well.
Okay, question number 8. What do you classify as an off-market property?
Yeah, so off market, it's definitely like just a catchphrase these days. And I for one, am one that use it all the time. And that's because we obviously do buy so much property off market. But there are different types of off market. So I'll quickly run through, I guess, what they are. There is the most pure form of off market property, which is, let's say it's us, we, the buyer, dealing directly with the vendor. So there's no sales agent involved. It's us speaking to the homeowner directly. So there's a few reasons that happens. One, our letterbox drops, door knocking, social media campaigns that we run for our clients when we know their requirements. And more recently, we actually have people reach out to us directly. I think it's probably it could be social media, but I think it might actually be the podcast who they're looking to sell in a particular suburb. They know we're buying in that suburb because they've listened to us and they kind of know where we're buying. And so they'll reach out to us directly. And obviously, like we're homeowners ourselves, like let's say they come to us with a property and it says, okay, I want $1 million for this house. I was like, actually, it's worth $750. So like a lot of the time, look, it doesn't mean we buy that property because if we don't see value at that price, we're obviously not going to buy it. But it's a good way to kind of, I guess, open additional opportunities for sourcing property. So it is, I guess, the most pure form of off market. The next one would be, I guess, probably two more. There's pre-market properties. So pre-market is basically an agent lists a property, they sign it up. They might be getting the photos done, they might be getting ready to take to market, but the owner is also keen to have a quick sale, or they're just kind of sizing up the market in terms of where they see value. So we'll get access to lots of properties off pre-market where the agents come to us and say, hey, I've got this listing. They're looking for, let's call it 850 to 860. That's where we're going to list it. Do you see value at this price point? Because we may be able to work something out. Sometimes that happens, sometimes it doesn't. But I call that more pre-market property as opposed to, like I said, true off-market. But again, another great way to buy property because, again, in the suburbs of buying right now, we can talk some examples in a second, but when there's 50, 100 plus groups looking at property and we can get access to the property a couple of weeks before everyone else, it means we're reducing that competition. So we're not necessarily buying at 50, 100K under market value, although sometimes we do. But it's more, okay, we've got time to do our full due diligence of the property, work through it. Does this meet our requirements? We're doing that before everyone else sees it in the market. So it may be that we're paying fair market value, but we're not overpaying for property if it was listed on realestate.com or Domain. And that's when you have all these kind of, I guess, sight unseen offers or first homeowners that are kind of FOMOing into the market. And that's where you obviously would miss out on the property. So we're paying fair value, but we're not missing out of it to someone that overpays for that property.
And particularly if something's going to auction, you just don't know what it's going to go for. And there was a really good example a few weeks back. We bought a property for clients in Frankston North, and on the same street, there was another property that was on the market and it was going to auction. That sold for over $100,000 more than what our clients paid for the property that we bought. They had 150 groups go through the property that was on the market on the same street, whereas we were the only buyers advocates with access to this property in Frankston North. So you can just see 150 groups. There's obviously going to be a lot more competition, and when that goes to auction, you don't really know what it's going to go for.
Exactly. Yeah. So that is one of, I guess that's the second one. And then the third one, it's still an off-market property, but it's where it's similar to a pre-market property, but in this case, there is no intention to list it online. So we bought a property like this recently, and there's quite a few in these pockets we're buying in because there is a lot of investors looking to sell out, whether that's because of land tax and they own 4 or 5 properties in Victoria and they're hemorrhaging money. But if let's say in this case it was a property that had been rented for 15 years. They had just signed a new lease, but then due to change in circumstances, they needed to sell that property. Let's just say it didn't present very well. That's probably the easiest way to describe it. So there is no point in this vendor spending $5,000, $6,000, $7,000 on marketing, and they're not going to be able to get staged because the tenant obviously still lives there. But it didn't present well at all. So it's not going to get first homeowners. It's not going to get premium price, even if they kind of listed online. So it makes sense for them to have their figure in mind and then offer it off market. So agents will send it out to their database, they'll send it to kind of trusted buyers, advocates and that type of thing. And then we'll get an opportunity to access property. Again, that's never going to be listed on Domain or realestate.com. Some agents will send that out to kind of hundreds of people. And so it's still a off market, but I wouldn't say it's, I guess, accessible to everyone, particularly if you're only kind of getting into this market for the first time. But that would be the other type of off market property. So for us, I'd say we'd see at least 20 or 30 off-market properties a week, but it doesn't mean we buy them all. I'd say we're realistically maybe 2 or 3 of those off-markets would be worth buying or at least worth further attention. And a few reasons, a lot of those off-markets could be on main roads. They might just, their price expectations might be too high. So it really just comes down to if we see value and whether they kind of fit a requirement for our clients.
Okay, next question. A bit of a controversial one. Are real estate agents underquoting on purpose?
Yeah, look, we can talk about this one all day. I'd say yes and no, right? So there are some agents, and we know who these agents are, that perennially, not for a year, not for 2 years, for 15, 20 years, are underquoting. They just are. Like there's no kind of like speaking, obviously quite frankly, they're just underquoting properties, particularly more affordable suburbs when they're trying to drum up kind of first homeowner interest. They want to get as many people through auctions. So we see it a lot with auction campaigns where they underquote properties to get that kind of level of interest, give people kind of hope. And then I think it's almost like a self-fulfilling prophecy in the sense where like they might go to the 5 of these auctions, it's underquoted, they keep missing out. And that's when they start FOMOing into these kind of a higher price point at auction because they're sick of wasting their weekends and kind of sick of getting conveyanced at a review a contract, which has a cost, getting building and pest inspections done prior to auction, which comes at a cost. And that kind of over time leads to more kind of emphasis in the market. I don't think all agents underquote. Some agents I've seen, we've obviously done this as well. We've put in unconditional offers on. So let's say it's listed for $650,000 to $700,000. We've put in an unconditional offer at $720,000. The vendor has not accepted that, and then they are legally meant to update the price guide. We have seen instances where they don't do that because they're going to auction and they don't want to scare people off by raising the price guide. Let's call it 3 or 4 days before auction, which is what they meant to do. But we also have seen agents do that. We've put an offer in at $720, it's rejected, and then so they'll then update the price guide to $720, $750 or something like that. So I don't want to say all agents are doing that. Some definitely are. Some aren't. But again, I think some are actually being caught off guard. And there was another instance recently where it was significantly underquoted, but it was an out-of-area agent. So they don't usually sell in a suburb. And we see this a little bit where it actually happens where their understanding of the market might be 12 months old. And again, we're talking Frankston again here. They hadn't sold in Frankston for 12 months. They priced it off what they kind of thought it was worth. They had one open home. There were probably 80 groups through because it was so underquoted. But again, they updated that quote straight away. And that wasn't based on an unconditional offer. It was like, okay, I've made a mistake here, updated the price guide, and then obviously gone from there. So one tip though, just for, I guess, anyone listening that is feeling like they're, I don't know, particularly for interstate investors and maybe homeowners, but investors we see that they may have bought in Queensland or WA or somewhere else recently and they look at Melbourne market online. So they go to listings and be like, oh, how good's this? It's a price guide, $750 to $800. I know what it's roughly going to sell. This is such a transparent state to buy property in. And then they obviously go through the process a few times and the properties are selling 100, 150 grand over that price guide. Obviously, it gets a bit frustrating. And we've actually had clients reach out and that's why they've signed with us because we're sick of wasting their time and they're like, okay, I just need to know what these properties are worth. So the quickest, tip for people is instead of looking at properties available right now and their price guides, look at what's recently sold. So just go to realestate.com, go to the sold tab and then search by that because that'll give you a much more accurate reflection of where the market's at right now.
Should I renovate or relocate? I think this is probably more a question for me. It's also another it depends answer. So for me though, really that cost of stamp duty alone would probably be a deterrent for relocating. So I think on a $1.2 million purchase, you're going to pay around $65,000 in stamp duty. So I think that's a really big deterrent to selling and relocating. But then again, renovation is not for everyone. So if your current home doesn't fit your lifestyle and you need to renovate, that's going to come with its own expenses and costs. It's going to be stressful. It's going to take time. So it really depends on whether if you can justify that stamp duty cost and the efforts and everything of moving home, then go for it. But you need to factor that in.
Yeah, one more for you. For us, we'll obviously renovate properties for investors if we need to boost cash flow, boost obviously rents and equity and that kind of thing. But yeah, I think it's really a personal choice, right? And I mean, someone submitted the question, but you need to know more about their personal circumstances before kind of making a call on that. That's for sure.
Okay. I think that's really it for the questions. We had a couple of others sent through, but we're sort of nearing the end of today's episode.
I got one more here, I know, and this is completely off topic now, and I think it's mostly from what I've been saying, but Lindsay, are you also a Demon supporter?
Oh, I wasn't going to mention that one. So those that are listening, Sky is obviously a tragic Melbourne Demons fan. I actually grew up in North Queensland, so AFL barely exists in North Queensland. I had no idea how devoted AFL fans were until I met and married Sky. buy. I am by marriage a Melbourne Demons supporter. It was in our wedding vows. So
doesn't sound very committed in terms of saying it's only by marriage, but yeah, true. It's I guess I could say the same thing. I'm now a married North Queensland
Cowboys fan.
Cowboys fan, yeah.
I mean, technically, I'm a Demons member.
Sure, yep.
Now that we've got young kids, it's great because they do love going along and they're obviously very into it. So it's growing on me.
Okay, all right. It was a longer answer to the question than I think we needed, but very good. All right, well, thanks to everyone that's listened to this podcast. And for those joining for the first time by video, great to have you on either YouTube and obviously through Spotify and a few other places where we're going to push it out. So great for that. Next week's episode, again, it's going to be a deep dive on the most requested suburbs we have. So obviously today was just Q&A on some of the questions people have had, but we're going to do a deep dive on particular suburbs. Again, some that we definitely would buy in, some that we definitely wouldn't buy in. So we're going to break that down, both from an investment perspective, but also for our own occupier listeners as well. That's a wrap for this episode of the Melbourne Property Podcast. Just a reminder that this information is general in nature and should not be considered financial advice. If you'd like to discuss your personal situation, book a discovery call with the team at Convergence Buyers Agents. Our link is in the show notes.
If you learned something from this podcast, hit subscribe and never miss your fortnightly dose of Melbourne property insights. Catch you next time, and happy house hunting.